Good morning, everyone. Welcome to this update for global stocks and commodities for the 17th of December. And this will be the final video for the year. I'm going to take a break for a couple of weeks, but I'll be back in early January with a continuation of this next year. So it looks like it's going to be a very good news finish into the end of the year with the US tax reform highly likely to go through. The Australian government looks like it may have escaped with the by-election in Bennelong on the weekend. So markets have got a pretty strong sentiment around them, and certainly in the States that is well and truly justified. So let's jump in and have a look at this particular update. It's going to be a shorter one this morning. I just want to cover what the twin purposes of these updates are, because I do get some questions from people from time to time about why I do these and why I've been doing them for the best part of 8 years. There's a couple of purposes. One is to provide an educational perspective on the market, a factual perspective on the market that I think will help you be much better investors. And it's not always easy to get that sort of perspective from all the media noise out there and the people that are trying to sell a headline or sell you a product. So the things that I focus on are the things that I think are really important. Some of them might seem a little bit boring at times, but I can assure you they are vitally important if you want to be consistently successful in the market. So that's the first purpose. The second purpose, and just as importantly, because this is really hard to do unless you're across the market constantly, and that's to time your overall exposure to the market. And in the last week, I've just released another update video on the process that I use in terms of timing the market, the bigger picture. And I looked at the peaks in 2000 and 2008 and what we could learn from those, and how to spot an impending bear market many, many months, sometimes 6 to 12 months in advance. If you haven't seen that, go to the YouTube channel and have a look at that. I think you'll find that really helpful. But I do that probably 4 or 5 times a year, and certainly as soon as any evidence comes to light. But my intention there is to keep you in the market when you should be in the market, when the bull market is still progressing, to identify the times when you should perhaps stop buying and adopt a bit more of a cautionary stance on the market. And then, of course, most importantly, when the market is demonstrating to us that it's going to break down and we've got a significant bear market ahead of us. So I think that that timing is of absolute essential value, and that's one of the key things that I'll be seeking to monitor. So if you continue to watch these videos each week, then I think it's safe to say you're not going to be caught short in terms of the market doing something unexpected. Of course, the normal stock and commodity trend update in this edition, and in Portfolio Analyst last week, I reviewed Telstra, not in a positive manner, I might say, and also a couple of local resource plays as well. And there were also several confident buys in America. So it was I think it was a pretty good session last week. And of course, the overwhelming case for overseas investing. If you're just investing in Australia, you really are playing a very, very limited game. So let's look at the American market. The S&P was higher by 1% on the week, another new all-time high. And can you believe it? It's closing in very quickly on 2,700 points. And it wasn't really that long ago that we were talking about the market just breaking through 2,000 and 2,100 points. So to now be standing at 27, it just seemed like a bridge too far away. The US is poised for major tax reform, and the impact is going to be extraordinary, and I've been outlining that in previous weeks. And I don't believe it's certainly not fully priced in, that's for sure. And the reaction on Friday night really underlined that. But I think there's still plenty of upside to be priced in from that source. The rotational themes of the last 6 weeks with technology stocks and China stocks not exactly going down, they're really going sideways. They're having a little bit of a pause or correction, and money is flowing into other sectors, and that has certainly thrown up a lot of high probability opportunities. There are really just almost too many to deal with. So it's a very exciting period in the States. The US dollar was flat for the week, and it's hard to say in the very short term where that's going to go. The US Fed has now raised interest rates for the third time this year, and they're pointing to 3 interest rate rises next year. But look, it's all pretty mild and steady stuff at the moment. Well, let's take a look at the US indices. This is the S&P. You can see we are starting to get a little bit elevated above the 50-day moving average. So I wouldn't be surprised to see a bit of a mild pullback. But look, that has been the case. Now we got one short little excursion to the downside on the 15th of November. But you've really got to go back to August to when we could even come back to the 50-day moving average. So it continues to move very, very strongly. We started the year at 2,250 points, and now we're almost at 2,700 points. So it's been an amazing year for the gains, but it's also been an amazing year for the lack of volatility. There's just a flat period here, another gain, another bit of a flat period. There's almost no retracement in the market whatsoever. And the fundamentals are really quite supportive of that continuing. Now, the NASDAQ has been, I'll look at the QQQ, which is the ETF covering the NASDAQ, had been a little bit weak from late November through till about the end of first week of December. So we had 4 or 5 sessions there where it was down a bit, but you can see it rebounded very strongly, particularly on Friday. So things looking very positive in the NASDAQ, and even the Russell 2000 for small caps continues to trade near its all-time highs. It peaked on the 4th of December. It's pulled back a little bit, but really nothing untoward there other than a bit of consolidation. So very, very positive signs there. Let's look at the US dollar. So we've come down to a support level. We've had a significant rebound and now a partial retracement of that rebound, which is normal. So we're sort of in limbo at the moment. I think it's a toss of a coin which way the US dollar goes. From a fundamental perspective, the US dollar should rise. But from a technical perspective, there's really no indication either way. So the Australian stocks, our dollar was sharply higher after almost breaking 75. Got back to 76.5. I think that was partly due to the jobs report in Australia, which may actually have some one-off factors in there. So I think the market might be getting a bit unnecessarily excited about the Australian dollar. There's the support levels. That's been the case now for a number of weeks. Our index gained 4 points the week before last, another 3 last week, but still unable to hold above 6,000. So we've had a couple of excursions up there, but it just can't seem to hold it. There's plenty of speculative resource activity. That's probably the main game in Australia at the moment, which is, of course, high risk and not to everyone's taste. But that's really where the activity is in Australia. So hence, in Portfolio Analyst Wire, I did spend some time really identifying the reasons why you really should be investing overseas. There's just so much more to shoot at. The trends are much stronger and more sustainable, and there are sectors over there, industry groups over there that we just don't have access to here. So very, very strong case in that regard. Let's just take a quick look at the ASX 200. So you can see we're still hovering around this 6,000 point mark, and really you've got to go back to January of 2008, and we're still well well below that peak. And if you compare that to America, which is at 2,700 points compared to a peak of 1,550 in 2008, that really underscores the difference between the two markets. This is gold on a daily basis. We had a bit of a rebound, but you can see if we look a little clearer on the weekly. On a big picture level, we've got a rising wedge happening, but that could take another 6 months or more to resolve itself, and we really need to get a break above 1380 to indicate that gold's heading higher. And I think gold it's certainly suffering from a number of things, but I think all this mania around cryptocurrencies is certainly not helping gold one little bit. So gold higher by 7. And precious metal stocks. GDX managed a small gain, but it's a very stock-specific sector, and particularly so in Australia. Some of the local Australian producers are actually doing quite well. I've made mention before of my favourite stock in Australia, and it's trading very, very close to all-time highs. So in the precious metals market, personally, I would be extremely careful with explorers and developers. I'd be sticking with the producers in Australia because they seem to be outperforming the price of gold. Turning to other commodities, copper came up, bounced back up strongly to 310. I think the week before was a bit of an overreaction to some data out of China, so that was probably a rebound to where it should have been. And crude oil was steady at 57.30. As far as stocks concerned, it's still a sector in transition, but there are a few outperformers, and they're outperforming by a very significant margin. So it really is a sector to do your homework and identify the best stocks, not necessarily just to buy the majors or to buy an index. There's the spot copper chart showing the rebound. There's oil, not a lot of change over the month. So to wrap it up for 2017, I think we should probably, I don't see any reason why we won't get a strong finish into the end of the year. There's effectively another 5 trading sessions and then some very quiet sessions between Christmas and New Year. But I would expect that we're going to see a positive finish. I expect the bull market to continue in 2018, not because I want to make a prediction, but because I just cannot see any circumstances that's going to change what we've seen through 2017. There's just nothing. And with the American tax reform highly likely to pass, it's just going to make things so much better in America. So it's difficult to see what will disturb this momentum in next year. And there's going to be many stocks that are going to make significant gains next year, particularly the stocks that have started to emerge leadership in the last month or two. So this is where your organizational skills are important, where your trade management skills are important, as to how much money you make. Organizational skills are critical. It's easy to identify opportunities, but you've got to have a process for monitoring those, because when they first come to your attention, it's often because the price has just moved up. Perhaps by 10 or 15% or 20. You don't want to buy them straight away. It may be 3 months before they're at a suitable place to buy. So organizational skills are critical. That's what I do in Portfolio Analyst. I monitor stocks constantly. It's what I do in my main memberships. And if you don't have the time to do it yourself, then there are other alternatives. Portfolio Analyst this week, I've got a very good question about the value of analyst ratings as far as future price movements go. So I'll be dealing with that. I think that's a very important question. And there'll be a couple more gems presented as well, both in Australia and in America. So that's it for 2017. I hope you've got a lot out of these weekly videos. I'll be back with you in a few weeks. I'd like to wish everyone all the best for the festive season. There's my contact details, and I'll be back with you next year. Cheers.